So JP Morgan did a study with about 31,000 people and discovered that 84% of people are probably making a mistake with their RMDs. I teach personal finance at a Big Ten university and own a wealth management practice. So I not only care about this information as I use it for my clients, but I've seen this firsthand. I recently onboarded a client because they learned too late about this mistake. And so right now we're trying to devise a plan to get them back on track. Don't make this mistake. Keep listening. First, let me just catch you up quick on RMDs. When you put money into your pre-tax retirement accounts, so these would be things like a 401k, 403b, traditional IRA, etc., you receive a tax deduction at that time. But as I tell my students in my personal finance class, Uncle Sam has to get paid eventually. And that's where RMDs come in. This is a required minimum amount that you have to take out of these pre-tax retirement accounts so that Uncle Sam can get some tax revenue. Because you didn't pay any tax on this money when it went in, you got the tax deduction, you now have to pay when it comes out. So that's what the RMD is. It's a forcing mechanism for you to pay taxes. The IRS cares about this so much that there are huge penalties if you don't do this right. So if you don't complete that RMD, there's a 25% penalty you'll owe based on how much you should have taken out. Now, if you do remedy this within 2 years, that penalty does drop to 10%, but that's still a ton of money. So you better pay close attention to this. Do not forget it. The age at which you need to take RMDs does depend on your birth year. There's a chart on the screen right now showing which RMD age is associated with your birth year. They've been increasing this over time. Who knows if it increases in the future, but right now, this is the information that we have. So when it comes to taking these RMDs, here's the general gist of what happens. You look at your traditional or pre-tax retirement accounts as of December 31st of the previous year. Then at some point this year, you need to take out a certain amount of money based on the previous end of year balance. So how much you need to take out, though, is calculated using the IRS's life expectancy factor. There's a few different tables that the IRS uses given one's particular situation, but most people will use the uniform lifetime table. Here it is on the screen. I took it straight from the IRS website. You take your balance as of last year on December 31st and divide that by the life expectancy factor that corresponds with your age on December 1st of the year of which you're making the distribution. I'll give you an example, so don't worry if it's tough to follow along. So if it's this year and you'll be 75 on December 31st of this year, you would take your balance at the end of last year and use the lifetime factor given by the IRS for a 75-year-old. So let's do some numbers in a quick example. Let's say this year you'll be 75 on December 31st. This means that your lifetime factor is 26. The balance of all of your pre-tax accounts last year on December 31st was, let's say, $1 million. To determine your RMD, take your balance and divide it by your lifetime factor. And voila, your RMD amount will be $40,650. I do have a link below to a free and I would say very useful RMD calculator from NerdWallet. Helps you determine that lifetime factor that you should use. And it's what I've been using on the screen. All right, so we got that out of the way. The question is, what's this mistake that JP Morgan found? Well, they found that 84% of people were only distributing, of retirees, were only distributing the minimum from those retirement accounts. And for 80% of retirees who had not yet reached that RMD age, they haven't withdrawn anything from those pre-tax retirement accounts. There's a lot of discussion online about this study and what the issues are. You have different opinions and different things that they take from this, but I've boiled them down to two things that stick out to me. One, people aren't spending enough. Really. And two, there's no strategy. So according to JP Morgan, they found this too, that the data is showing that retirees are probably not withdrawing enough to help meet their spending needs early in retirement. They're either pulling from other funds in a Roth or taxable account, which may not be the most efficient, or they're not actually spending the money. This both creates a present and future issue. The present issue is not enjoying retirement. But the future issue is that the retirees will probably end up with an increasingly larger pre-tax account towards the end of their life and thus heavy RMDs in the future when it could have been more beneficial to take out more from their pre-tax accounts in the early years of their retirement when they have more expenses. Oh, but John, you might be saying, don't your expenses increase over time? Well, here's what the data actually says. In my circles, this is commonly known as the spending smile because expenses in retirement are higher when you first retire, which makes sense, right? You have the health and energy to do things, but as retirement continues, your spending actually decreases. This chart from JP Morgan shows just that. What's not shown is that at the end of your life, your expenses can increase temporarily for a few years due to healthcare or long-term care costs. So what this creates is a smile, so to speak. That's why they call it the spending smile. So what the authors are trying to stress is that these retirees are probably not taking out enough to enjoy retirement, as the RMD withdrawal strategy, where you only take out what your RMD is, leaves you with more assets later in your life in pre-tax retirement accounts that are by far the worst thing to pass down in an inheritance, other than, I would say, maybe smelly sweaters. The second issue, and the one that I think is actually the most pressing, is that there's clearly no strategy for these retirees before or after they take their RMDs. Now, as you know, every situation is different, but a common, and I would say often successful strategy we use to minimize lifetime taxes for a client is to pull money from pre-tax and taxable accounts early in retirement before RMDs. This comes often in the form of Roth conversions, and this serves multiple purposes. First, it reduces your future RMDs. You're pulling money from those pre-tax accounts now, which means that in the future, you will have fewer required minimum distributions. I'd rather pay the tax when I want to pay it than when the IRS is telling me. The second thing is that you are filling up lower tax bracket buckets. And this can be really helpful because later in life, maybe you have more income than you expected. Maybe your investments are doing better. Maybe the stock market's doing better. So you might end up paying a higher tax on that money than if you filled up some of those lower buckets earlier in retirement, maybe the 12% or 22% bucket before you get into 24, maybe above that into 32. The third purpose is that it's increasing Roth assets that we let grow through retirement. This was from the Roth conversions. All of this is done to minimize your lifetime taxes. No exaggeration. I have seen that by filling up this Roth bucket earlier in retirement, this can save hundreds of thousands of dollars in taxes over one's lifetime. Sometimes it makes sense to bite the tax bullet now, before or at the start of RMDs, so as to decrease that tax hit later on. If 80% of retirees haven't taken anything out of their pre-tax retirement accounts, they clearly have no plan and are leaving money on the table. I believe in paying the IRS what you owe, but never leaving a tip. Thanks for watching. If you were ready to outsource this part of your life to an expert, see the link in the description below. Godspeed and happy planning.